Hey everyone, I'm Joeri Schasfoort, your host today on Money and Macro Talks, and today I will be talking to Professor Jan Eeckhout about why high profits are actually bad for the economy. Jan Eeckhout is a research professor at the Barcelona School of Economics. He has an extremely impressive resume, actually, having taught at many top universities and having published in top journals where I could only dream to publish, like the Quarterly Journal of Economics, American Economic Review, and Econometrica. And crucially, he wrote this super interesting book, The Profit Paradox. And this is the thing that we'll be talking about today, the profit paradox. Hi, Jan. Thank you so much
Hi,
for
Yuri.
coming on the show. I always just like to get into it straight away. So, can you perhaps start by explaining us the core message of the profit paradox? What is this profit paradox, and why is it a paradox?
Yes, very much. First of all, thank you very much for having me on here. So, the way I think about the profit paradox is probably best illustrated through an experience I had. Probably just before the COVID pandemic, I met up with a friend of mine. I hadn't seen him for a while. He was until then living in Silicon Valley, and he had several startups. We meet, we greet, we talk a little bit about family, and then I ask him what's going on with work, and he says, "Well, I'm moving out of Silicon Valley. It's finished, and the reason why is that my second startup has failed, and I'm moving out." And as we're talking, we're sitting in a bar. We see on the screens, this was in New York, we see on the screens of the bar that there's a CNN newscast just at that moment saying that the Dow Jones had reached, I believe it was 30,000. It was like a symbolic landmark. And so then at that point, the news anchor was saying, this is great news for the economy. The health of the economy is extremely good. And as we hear that news report, I see my friend Alex. He's kind of shaking his head and says, "Not for me." And I dig a little bit deeper and I say, "What's in it for you, or what was not in it for you?" And he says, "Well, I've been for more than 15 years in Silicon Valley, and my experience there was that." Over time, it has become much harder for startups like mine. Of course, startups do fail. That's the whole point of startups. But, I see a lot of them. I have a lot of contacts in this world in Silicon Valley. And everyone agrees that for these startups, it has become much harder than it was 20 years ago, 30 years ago. And as we're talking, the waiter comes. It was a quiet afternoon, and the waiter was overhearing a conversation and says, "You know what? I mean, I don't think that this is a good news show in terms of the Dow Jones reaching 30,000 for me either, because I'm taking home exactly the same wage as I did 17 years ago when I first started this job." And so, what is the profit paradox? On the one hand, you have these enormous profits because ultimately, what is high stock market valuations? It means that firms are making high profits. And on the other hand, you have the rest of the economy, and that is startups, that is wages of people who do production service jobs, who are not kind of seeing this healthy economy that the stock market is experiencing. And that's basically the bottom line of what the profit paradox is about. And then the next kind of step is, where is this coming from? And I isolate a big determinant of that, and this is the whole point of the book, is that we see that what we call market power dominance of large firms has increased, and this has enormous implications for the entire economy.
Yeah. So, what's good for the stock market is no longer good for the economy, and that's really quite new-ish, I guess, right? That this is not what we used to learn in Economics 101, maybe 20, 30 years ago. But it is something I think that resonates even more today, right? Like even now, looking at especially the US, the stock market is again doing great, but people just don't feel that anymore. And you're saying it's really that big companies have become way more powerful. So
That's right.
what's your evidence for this?
So we have different sources of evidence and different ways of measuring what market power is. Historically, people have looked at what they call a concentration index. They look at a particular market and they calculate what is called a HHI index. This is basically a particular way of measuring how concentrated an industry is. This is very often used in court. The Department of Justice in particular uses this as evidence, for example, to block mergers. Okay, there's a candidate merger going on, and different parties, it may be the FTC or the Department of Justice, is going in front of the judgment says, look, I mean, I see here the HHI index that's very high, meaning that the industry is very concentrated. That's one, as economists, we're fairly skeptical about it because it has different drawbacks, and that's kind of a methodological discussion. The other measures we look at is one, markups. What is markups? Is the price at which you sell a good relative to the cost of producing it. This is something that is not easily but fairly straightforward to calculate out of accounting data. And what we see is that the average markup has gone up from around 1.2. That means that, you sell a pen for 20% above the cost, okay, 1.6. So in 1980, it was 1.2 to 1.6. Today, 1.7 we get. And so that says that, they have huge margins now, that much larger than they used to have. There's two things about this measure, and in fact, all other measures, is that this is an average, and it means that the margins of some firms are way higher than that, whereas the margins of most firms are actually the same. So if you look at what we call the median firm, out of 100 firms, we take the 50th firm and we rank them by these margins, that 50th firm's margin is the same as it was in 1980. The reason why the average has gone up is because we have what we call a tail. These very dominant firms have now margins of 2, 3, 4. Okay. And this is in all sectors. Maybe surprisingly, it is in the tech sector. We all know the big tech companies, but it's also in other sectors, in particular, where firms that use tech heavily, and today, I guess it's AI, but in the 90s, it was probably how much access they had to, for example, the World Wide Web in their sales and logistics and things like that. And so over these 40, 45 years, what we've seen is that these firms that use this digital technology very intensively have been able to create huge margins. Now, there's a caveat to that. And I come with that caveat to my second measure that we also use, which is profit rates. The caveat is that maybe I need bigger margins because I have huge investment. And if you think about, say, a social network company like Meta or like LinkedIn, their cost, or maybe, a rideshare company like Uber, their big cost is to set up the whole architecture, the platform. And you have an enormous upfront investment. And then the cost of production actually becomes very low. I mean, having one more user on Instagram is just no cost to them. But setting up the whole software must be done before even you have the first user, and that's costly. And so maybe the reason why they have now these higher margins is because they have these very high upfront investments. And to our second measure, the profit rate, which is basically looking at not just the price relative to the cost of production, but it's really looking at all the income and all the cost, everything, including these upfront investments. And what we see is that even these profit rates go up. They go up from around 2% of sales to around 8% of sales. Okay, and that's a massive increase because these firms basically now have enormous profits that they didn't have. But again, it's not all firms. There's a small fraction of firms that have much bigger profit rates than most of the firms. And in fact, there's now more firms that have negative profits. Okay, that basically, hang on, then typically default and go bankrupt, or some of them hang on, but they're really, really struggling. Okay, and you hear this very much when you talk to people, for example, in human resources, how they be pressured by companies like LinkedIn, how their margins are squeezed because what they're doing is basically squeezed by the presence of one of these large dominant firms. If you talk to journalists in general, people who are on the business side of, say, their regular press, TV, they feel that their margins are squeezed by the advertising revenue being taken away from social networks. And so, again, these profit margins on average have gone up sizably, but have gone up a lot for a few firms and haven't gone up for most firms, or they have gone down. And so that's basically our second measure of looking at, where the evidence is. And then we have a third measure, I should say, in addition to the first one I measured in the outset, the concentration ratio. The third measure is looking at the stock market. And why? Because the stock market, the value of a firm is really the sum, suitably discounted, of course, of all the stream of profits that you expect in the future. Now, there's a lot of uncertainty about this. These discounting, how much should you discount? What do you expect? But the good thing, and that makes it kind of a very volatile measure in some sense, but the good thing about the stock market valuation of firms is that it tells us something not just about what the profits are today, but what the profits are for the entire future of this company. And so what we see there is again the same thing. The stock market valuation on average has grown a lot. That's where I started with the Dow Jones. But if you look, for example, how this is distributed, and again, that distribution of stock market valuation has become so kind of much more unequal. Okay. This has become so much more unequal because as you look at the distribution of the stock market valuations, what happens is that there's a few firms that really capture most of the stock market valuations. In fact, in the last year, the last 2 years, 7 firms have captured this. Maybe with the exception now in the last 8 months of Tesla, but it's basically the 5 tech firms, Nvidia and Tesla. And if you look at that, the entire stock market valuations in the US, this is not just S&P, this is S&P, NASDAQ, everything that's being traded publicly in the United States, 25% is basically accounting for these 7 firms. And not only that, the growth of the last year of the stock market is due to these 7 firms, and that's 50% of the entire growth of the stock market. So we see the stock market going up like crazy in the last few years, but a few firms, 7 in this case, capture 50% of the growth. And this is again telling us the same story that markups of these margins tell us, that rates tell us, and that the stock market valuations tell us that yes, stock market has gone up, profits have gone up, but only for a very small number of firms that really kept the entire gains. And most firms are actually not doing so well. And we see firms struggling also in their stock market valuations.
Okay. So you essentially have 3 measures. You didn't count this concentration index because it's a bit flawed, right? So you just look at markup. So that's per profit, per product profit basically. Total profits, taking into account sort of fixed costs more, and then the stock market, and all of them tell the same story, giving you confidence that your hypothesis is correct. You use always the example, so far at least, of the United States. Do you also see the same pattern elsewhere? Because for the US, I think it resonates with a lot of people. Do you also see it elsewhere?
Yes. In fact, we we have a study where we use a database for firms around the world, all publicly traded firms around the world. And so basically this gives all countries, the coverage for some countries is sometimes sparse, especially in Africa. But where we have good data is North America. That includes basically the US, but also Canada and Mexico. We have good data for Europe. We have good data for Asia. And we have good data for Oceania, basically Australia and New Zealand. And what we see there is exactly the same pattern. Maybe where the biggest difference is in Asia, where the increase is not as stark. And part of this is because China is a big player in there. And in China, what we see is that these markups, for example, or the profits rate, for some firms have actually declined. And which firms are they? They're the state-owned companies. And so these former behemoths, which are still big, been losing market share, have been losing dominance because of inefficiencies and things like that. But if you take those out, the story across the entire world globally is very similar, whether we look at markups, whether we look at profit rates, or whether we look at stock market valuations. And this tells us that is, like the can carry in the coal mine here is that it's about something that's common to all countries. It's not looking like policy. Our first reaction was 1980. Well, Thatcher and all these policies, and there was actually movement on the antitrust front. Yet in trust fund at that time, there was what is called the Borg doctrine, which was basically saying Borg was a lawyer from Chicago, from the University of Chicago, and he was very influential within the Reagan administration. He was arguing that we shouldn't really intervene in markets because markets are competitive, and this was following the AT&T breakup in the Baby Bells, which happened through the late 90s and finalized in the 70s and finalized in the early 80s. And the argument was, the markets are competitive. And in fact, at that time, there was a study by Harberger. Harberger also is a Chicago economist. Markets were pretty competitive. And our data confirmed that in 1980, the markets are close to fairly competitive. And so, you know, what at that time, it was like, okay, let's not worry about antitrust. Okay, maybe the markets were competitive because there was antitrust enforcement. And then when you stop doing it, of course, the market power goes up. So policy is an issue, but what the global data tell us is that technology is probably, you know, as much and what we find quantitatively a much bigger issue. We find that it accounts for about 80% of the rise in the markups. And, then why 1980 digital technology?
Mm.
Because of course, digital technology existed. There was digital technology in the Second World War. I mean, they were using networks and they were using ways in which digital technology, maybe with punch cards, but they had digital technology. 1980 is really the point in which households, firms, society as a whole starts to use computers. Okay, most people bought their first home computer somewhere in the 80s. And firms started to move maybe their accounting exercises from books to computers. And that happened in 1980. Of course, Apple was founded in the mid 70s, Microsoft was, but, by the time they really became an economic player or had an economic impact macro wise, that was not until the 1980s. And then you see 1980s, of course, I already hinted at this. Things are different in the 80s than in the 90s. Maybe in the 80s, it's starting to use computers and servers. In the 90s, it's the World Wide Web that comes in action and has an economic impact. The 2000s, it's probably all mobile technology, mobile phones. 2010, it's probably big data. 20s, it's probably going to be artificial intelligence. The period, it's not just this one thing, press a button, and this is digital technology. This is an evolution. And like every industrial revolution, this is an evolution that takes time and it's stretching out. And, we haven't seen the end of it yet. I mean, I think we're still very much in the middle of it. And it could be one of the longest industrial revolutions that we're living through, going on for now 45 years. And so I think that this evidence that this is a global phenomenon seems to tell us something about this uh, um, driving force being the digital technological change. And and what we see is that this digital technology has a few features that are very much aligned with what we see in terms of these dominant firms. And that is, well, they tend to have enormous returns to scale and scale economies. What does that mean? Again, what I mentioned earlier, you have a high setup cost, but once you have made that investment, producing is at a very low marginal cost. Additional cost of production is very low. And that is, kind of the perfect recipe for what we call a natural monopoly because, why would we have two fast or high speed rail lines next to each other to compete? Once one has been built, okay, then there's no point for a second one to come in. And in the same way, once a big platform has been built, why would someone else come in? Add to that there's another source of these scale economies, which is what we call network externalities. I mean, I like a social network because everyone's on that social network. That's where the value is coming from. And again, there's no point in having two equal social networks. It's much better to have one big one where we can actually reap the benefits of this enormous scale that we have. And that means that with these new technologies being very much scale driven, add to that the fact that we now have a global economy, that a lot of the activity that or markets in which you are operating are basically the whole world. That means that if before, of course, we had scale economies, electricity is scale dependent. If you build a nuclear power plant, that is all about scale. You can't just do that for 3 households. You have to do this for, I don't know the numbers about this, but maybe 200,000 households. And 200,000 is one thing, but now we're talking about 8 billion. And so we've had scale before 120 years ago when we started with electricity generating firms. Now, what we see is that the scale, if you're an Uber, is that you're thinking about 8 billion users potentially. Okay. And so once you roll this out in different countries, that scale becomes enormous. And that is why now, or during that period from 1980 onwards, we see such an enormous impact on that scale in the economy of a few dominant firms that use digital technology extensively.
Can I just challenge you on two parts of this story, which I find very interesting. So you mentioned, look, there's two potential explanations. There's policy and there's technology, and we found actually more evidence for technology since the 1980s. Um, I think I'm wondering. You probably checked for this, but I just wanna check myself. Didn't in the 1980s, of course, famously you have Reagan and a neoliberal revolution in the US, but didn't that sort of spread throughout the world? Like, didn't Japan also liberalize way more after that? Didn't this also spread to Europe a lot? And uh, d- how do you know if it's technology, but not actually the spread of sort of the more free market ideology?
Look, it's both for sure, and we find evidence for both. And in fact, if there had been stringent antitrust enforcement, whatever technological change you would have, antitrust enforcement would have basically had policies in place to make sure that markets continue to be competitive. So it must be both. That's kind of the evidence. And therefore, it's also evidence that given that the digital technology has had this impact and has been able to have that impact without being stopped in its tracks by effective antitrust policy, is evidence that antitrust is also, or lack of antitrust enforcement is also one of the sources of this. And so that kind of neoliberal ideology that you refer to, whatever that means, but the fact that there is no antitrust enforcement is part of the cause, in the sense that if you would have had the type of policies in place that are perfect and that we know that exist, and we can talk about what type of policies that are, in the 1980s, we would not have seen that enormous rise in these dominant firms. We would have seen much more competitive markets. We would have seen startups flourishing, because we haven't talked about the consequences that this has, but we would have seen a number of these consequences that would be very different from the ones that we see. And to your point, yes, that is because there was no kind of stringent enforcement of these pro-competition policies. By the way, I should also say that, sorry to interrupt here, but you know, it sounds a little bit contradictory, right? Because you say, oh, you have these all free market policies, but in a sense, if you have antitrust enforcement, you would have more competition. But more competition means that free market means you allow these dominant firms to flourish. And these dominant firms that are monopolies are really not very competitive. If you ask a business person, you say, what does it mean to be competitive? Well, that means that I, as my firm, I'm very dominant. I don't face many competitors. So basically, when I'm competitive, there is no competition from a market viewpoint. From a policy viewpoint, when you say a market is competitive, these dominant, what business people call competitive firms, are not there, because there's a lot of smaller players competing against each other. And so there's just this kind of funny play of words that people use the same term to really say exactly the opposite.
Mm,
And I'm
yeah.
really talking from the point of view of the policymaker that says, we need markets to be competitive. We don't need firms to be competitive in the business sense.
So before getting back to that, because I think that's really interesting, the second point I wanted to challenge you on a little bit is, you say, look, through technological change, scale starts to play this bigger role. And when you say, look, this is network effects become more important thanks to the internet, I'm with you. But actually, when I think about pre-1980s big firms, this is when I'm actually thinking about huge capital investments, the big oil firms, the big car firms. And on the other side, you have many Silicon Valley firms being started out of a garage, right? Skype being started by a small team, WhatsApp being started by like 3 guys or something, I think it was. Isn't that contradictory to what you just said?
I mean, maybe it's contradictory. It's just saying that the technology is different, because remember that the value, the capital of, say, a Meta or of an Apple, and maybe an Apple is kind of the most exceptional in that, of a Google, is intangible capital. So you don't see it, but it costs them a lot of money to build it. It costs, Meta a lot of money to build that base of users and to not lose them. And so they also have enormous scale because they have invested a lot of capital. It's just that it's not buildings and machines. It is intangible capital through a customer base, ways in which they, influence the advertising market to keep the advertisers on their platforms and things like that. And it's highly complex. And so, yes, it is very different from what it was before the 1970s or 1980s. Yes, it's a different technology, but at the same time, the scale economy is still part of it. And I would argue that, compared to, say, a General Electric that had enormous physical investment, let's say in the 50s and the 60s, that these Metas and Apples and Googles are even bigger, even though tangibly there's nothing there.
Hmm.
It is changing a little bit in the last few years because these economies and these economies of scale have become more tangible, because part of, let's call it in general, AI, cloud computing, data centers has become a technology which is like a 70s technologies. What is it? A power plant. It's a big factory. Okay. And it's really running like, like you used to run a car manufacturing company. Okay. And the reason, but even bigger, because, I believe it's Amazon, or was it Google, who recently bought a nuclear power plant in the US because they just can't really, find enough energy for the needs that they have. On top, I forgot one thing: they have to have water next to it, is next to a river to cool all this energy that's being generated to process those data. So in a sense, you know, kind of intangible, but it's becoming more tangible. And this is something that I'm a little bit worried about, because there's only three players who are making these enormous investments. And so now we're having a fight between the three of them, highly competitive, by the way. Okay, so,
Yeah.
and don't get me wrong, that these firms have become what they became because they were enormously competitive at some stage. And so part of this is that if you're fighting to become the dominant monopolist, to be that monopolist, there's other firms who want to be that too. And so to be that winner, to be, the lucky Zuckerberg who managed to make Facebook in what it is, and then Meta, you have to face not two competitors, you have to face 50 or 100 competitors who at different points try to enter your market. But what we see with this intangible, highly returns to scale new technologies that are in the digital sphere, is that these technologies, what they do is that they give you kind of a very competitive stage competing, for the market. But once you've won that market, in the market, there's no longer any competition. The same way that JP Morgan and Rockefeller managed to consolidate, the rail networks in the United States around 1900, was that there was fierce competition about, people or firms building rail networks. But then they consolidated them once they managed to, merge, buy up different firms. Once they had that monopoly, there's no longer any competition in that monopoly. The pre-stage was highly competitive.
Yeah, we saw it even very recently, right? During the pandemic, you had all of these food delivery companies, and it was so competitive for like 3 or 4 years. But now, and they were very innovative. But now, if you look at their websites, nothing has changed in a couple of
Yes.
years. And yeah, okay, that's really interesting. And before we get into the consequences of all of this and macro consequences, um, why can you maybe go into a little bit? Why is the market not self-correcting? Because you mentioned like, look, actually, antitrust enforcement is hugely important for exactly a competitive market, because we think about a competitive market in the most easy sense as, oh, the firms make all of these profits, like Microsoft is now. So every startup is going after them. The more profits you make, the more competition is the idea. But that's not working, right? Why not?
Well, because, I think we have this misconception, and I think I'm the first one to be responsible for that, is when we teach, we say markets are competitive. Okay. But there's a number of very strong assumptions that have to be satisfied before a market is competitive. And when it's not, then we don't get all these benefits that, the invisible hand that Adam Smith kind of advocated for is going to rise. By the way, Adam Smith's book is all about when it doesn't happen, writing down, the invisible hand, but be careful for this, and that. And he lists all the instances where it doesn't work. And I think, when I say I'm the first one responsible for it, what I used to teach is that we have to change our vision of what a market economy is, which means that it's like, I like to use the sports analog of this. If you let kids out on a playground, okay, what you're going to get? Well, the biggest and the strongest bully is going to have the best team and have even more players than the other team. If there's a bit of a slope, they're going to play on the upside. The other kids are going to play on the low side. They might even have the referee that's a friend of them. That's not how sports works. The way we organize sports is we make sure that there's a level playing field, that there's even financial constraints on how strong you can become, especially in the US sports. There's all these kind of balancing forces to make sure that the referee is independent, that we have the VAR that's enforcing, of course, that creates competition, but within an environment that's heavily kind of regulated, if you want, that's heavily governed. Because if you let, I always use being based in Spain, if you let Florentino Perez, who's the president of Real Madrid, who's a very powerful agent in the economy of Spain, but also, of course, in the football world. I mean, Real Madrid, they already win a lot. They would win everything because he would change the rules. He would have the referees, and that's not how the what's best for the user, in this case, just the public. Even if you're a Real Madrid fan, okay, you don't want it in the end because it's going to get a little bit boring, because if the competition is kind of false, if it's not even. And the issue is that, sure, selling sausages, butcher shops, they're competitive. We don't have to intervene in that. Making most of the stuff in manufacturing now, whether it's a pen or whether it's a piece of furniture, fairly competitive. We don't have to worry about these markets. As long as we deal with things like standards in terms of food and medicine, as long as we're flying airplanes, if we have standards for safety and things like that, most markets are competitive. The problem arises when you have certain markets, like the ones where this digital technology plays an enormous role, where you have natural monopolies. Then we have the problem. People say, oh, you also have fixed costs to set up a butcher's shop. Sure, but how much is it? And if you have a butcher's shop and I go to the next block in my city and set up another one, I can still compete with you. Of course, there's no point in having a butcher shop to sell 1 kilo of sausages. I mean, you need to have a minimum level, because, you have to pay the rent and you have to employ people. But the scale of it is so small. Okay, we're talking about, having maybe 1,000 customers. But when I talk about 8 billion customers potentially, then the scale is just so large that we can't get any competitors in there. And I think that's really where the market doesn't work by itself. That doesn't mean that we don't have policies to make it work. We have very good policies to make these natural monopolies competitive. Okay, and the type of policies that make it competitive are the type of policies, like in sports, where you have to have a referee, where you have to have a set of clear rules, and these rules are leading to more competition. Okay, they're kind of pro-competitive. And if I think about, I would say the word that encapsulates best these pro-competitive policies are what we call interoperability, or policies that are interoperable. And what is interoperability? It's a term that comes from the tech world in the 60s and 70s, and everything is operable in technology to some extent. If you think about, I can send you an email from my university account to your private account. Okay, so basically you have, or a Gmail account to my university account. You have two service providers, but the people who designed the internet says this has to be interoperable, the same way that the phone system is interoperable. I can make a phone call from a Spanish number to a Dutch number, and yours is a particular private provider, mine is a different private provider. We can make these connections. Why? Because at the highest level, there is an ability to connect. This is not true everywhere. If you try to send a message from WhatsApp to Telegram, that's impossible. There's no interoperability in messaging. Why? Because if you're WhatsApp, you don't like interoperability, because you like to basically try to become the big dominant player, which WhatsApp probably is. And that means that there can only be a few, because Telegram is probably for typically maybe, more in Russia, WeChat in China, WhatsApp, maybe the Western world. But ultimately, there's no competitors within these big blocks. Internet service providers, there's thousands. Phone company providers, there's a lot. And so basically what this means is that Interoperability says I have one network where if I would let the market do what it wants, it would tend to converge to one monopoly or a few firms that are in oligopoly. But if I put rules like interoperability and say, you have to allow these firms to who want to enter into this market to enter into this market. And I think the best example we have in Europe is that they've made the high-speed rail interoperable. This is now legislation that's coming from the European Commission that says, I have a train line between Paris and Lyon. And now the Spanish company can go on a train line. What is the network? The network is the line. There's only one. If it was run by SNCF, the French company, it's a monopoly. They own the line and say no one else can come on it. But now the new legislation says, no, if a Spanish company, a Dutch company, an Italian company, a German company wants to compete on it, which they do today, and they can, under certain conditions, so they have to pay a usage fee. They have to pay for the cost of using that rail line that's set by this European Commission regulator. If they have that pay that usage fee, they can decide how much to sell a ticket for. They can decide when at what time to put a train. And so basically it becomes now competitive the way that really airlines are competitive in Europe. They weren't 20 years ago when you had the national airlines. And of course, what does that mean? Well, I know it here from Barcelona to Madrid, the high-speed trains, service improves a lot, more offering, and especially lower prices. And that basically is, making a monopoly into a competitive industry, and a monopoly that, still has the advantages of the scale. We haven't built two rail lines to compete. That would be way too expensive. What we've said is, let's use one network and separate it from the operators. And now, how can you do that? You have to have that instance, the pro-competition authority that intervenes and says, here are the rules. I'm the referee. Here are the rules of the game. And of course, that authority must be working in the interest of the customers and the firms. It can't be that this is itself a kind of, an authority that says, what I'm going to do is I'm going to do the best for my own pocket, because then you introduce a new source of, it's like making a referee become for profit. He's going to take bribes. Okay. So you don't want to do that. So you want an independent agency that generates these interoperable environments that become pro-competitive.
Yeah, that's super interesting. It really reminds me of I recently tried to, and I know a lot of people here in Belgium tried to switch to Signal from WhatsApp after Facebook controversies, etc. But I only have my wife on Signal right now. It's that doesn't help, right? But if the European Union said, "Look, WhatsApp, if you want to operate in the EU, you have to accept other messaging sort of signals," then I could fully switch to Signal overnight. So okay, that's super clear, and something I had not considered before. So thank you. We only have 10 minutes left, so I just want to get a little bit into the consequences now, because we haven't talked too much about that. Could this also explain, for example, the productivity dynamic, productivity versus wage dynamic, for example, that we've seen? Like one, or maybe there's two things here. One question I've been reading a lot about is, why did productivity flatline or not increase as much after the 1980s? Could it actually be that it's because of this increased inequality between firms, that you don't see it on average? And then the second part is really like, why have wages fallen behind so much, right?
Yeah, I mean, there's basically two distinct aspects of it. One is the productivity itself that continued to grow fairly steadily at the same trend rate until, I guess, the Great Recession, 2008. And then, as in the US, we've seen a little bit of a slowdown, but then the US picked up again. Europe has slowed down more in the recent years. So there's quite a bit of volatility and possible slowdown in productivity. And there's a potential source. And the reason is because if you look at what market power does, it affects innovation. And ultimately, the source in the long run of economic growth must come from innovation. It must come from technical change that's basically making the productivity grow. As we see is that, it may sound counterintuitive, but these dominant firms, of course, they invest a lot in innovation. But if I would take, 100 small firms that are as big as one large firm, these 100 small startups jointly innovate more than this one large firms. And this is something that we see, that the innovation is actually declining in firm size. And so, of course, no one's going to doubt that Google innovates a lot. No one's going to doubt that Meta innovates a lot. But if I would put that, kind of technology in the hands of many small startups, that innovation would be much larger. So that's the first thing, and that's possibly a source of why we see that productivity kind of faltering a little bit. The second issue is the one that you hint at, which is the decoupling of the growth of productivity from the growth of wages. If you have a competitive economy, eventually, the wages must grow at the same rate as productivity, unless, there's something else going on. And what is going on in this case is that we see that the firms, if we see the pie that's being produced, that's the GDP, it could be at the firm levels of production, but also at the economy level, how is the pie sliced up? Some of it goes to wages, some is going to capital, and some is going to profit. And if we see that the share of profits has increased substantially, which we see not only at the firm level, but also in the aggregate of the economy, then it must come from somewhere else. And where does it come from? Well, in fact, the capital share has shrunk a little bit. This is something that's often forgotten, but it's also true that there's less capital investment. And second, the labor share has declined, and the discussion about the labor share is something that's been going on for a long time. This is, the first was pointed out by an English economist, Bowley, and then later Nicholas Calder, who's the Cambridge economist, who basically had his stylized facts. And one of these stylized facts is that he says, in the economy, as long as we've had data, we see that the labor share is around 2/3 of GDP. So whatever is being used to compensate for wages is about 2/3. Now, since the 1980s, we see that share declining. We see that declining from around 2/3 to around 58%. You might say that's not that much, but it's the first time we've seen such a decline. And that helps us also understand why we see a decoupling of the productivity growth and the wages, that there's an increasing gap starting in 1980, by the way. Now, the story is more simple and nuanced because there's a huge decoupling between workers and, let's call it, workers who are in production and services, whose wages basically in real terms have stagnated, are flat. But at the same time, we see a small fraction of workers, those typically with, not only a college degree, but college plus degrees, like masters, like PhDs, like MBAs, doctors, lawyers, that those wages, especially since 1980, have grown much faster, in fact, than productivity. And so not only is there a stagnation for those production and service workers, which are about 85% of the population, the working population, for 15%, we see now an enormous increase also in their wages, actually more than the growth in the productivity. And that also has something to do with the technology. So to kind of sum up the story, we see productivity potentially slowing down. We see a gap between production wages and productivity, and we see an increase in wage inequality at the same time, because for some wages have gone up a lot and for others have not. And we find these mechanisms linked to the rise of these dominant firms, because these dominant firms, of course, they generate more profit so they can pay less in wages. But at the same time, if your top superstar workers are contributing to generating those profits, they're going to get a share of that. If you're an engineer, and we've seen, maybe you've had a podcast about this one recently, but the wages that are being paid now to the AI coders, okay, they're just like beyond belief. They're talking about billions over 3 years for the top researchers. And so this is, I think, part of this story. If you have such enormous profits, and these profits, are increased because a coder with one line of smart code can, increase the profitability of your data center, that's, of course, going to be the coder that you want. And that coder is worth maybe $1 billion to you. And that's what you're going to end up paying for that coder. You can pay $1 billion because you're such a dominant firm. Because if you were a small startup, you would never be able to pay that amount. And I think that's, in terms of wages in the labor market, these are the biggest consequences. But it's not just the labor market where we see the consequences. We also see consequences that go far beyond that. The consequences that we see, for example, is going also to other businesses. Because, again, I started out with the story of my friend Alex and his failed startup. If you look at the startup rate, the number of startup firms out of all the firms, in 1980 was around 14%. It's down to 8% now. Okay, so we have far fewer startups, about nearly half of what we had before. And as I said before, startups innovate more. Startups are therefore kind of the engines, the building blocks of the economy. If you have fewer of those, and that innovation is going to be done to a lesser extent by the large firms, by these dominant firms, of course, you're going to get less innovation. And so the point is, we see what we call also decline in business dynamism. Okay, that there's fewer new firms with new ideas coming in this market. I use the example of they're like little puppies, these firms, and we want them to grow. We want them to come, well, if they grow like one of these dominant firms, they come a bit like wolves. They go after the sheep in your farm. But what we really want, we want them to be border collies to take care of the farm. And that's what the customer would like. And so we would like to have a lot of, puppies that grow into many border collies rather than these puppies growing into a few wolves that are basically not being very beneficial to the rest of the economy. And then business dynamism is also seen in the kind of how even larger firms, how fast they turn over their workforce. And you might say maybe this is a good thing, but we know that the type of business dynamism which has fallen to half, from around 35% of all workers turning over every year to around 20-something%. Okay. Why is that not beneficial, or why is this detrimental? It's detrimental because firms really live off the dynamism they have by reallocating workers, by getting new workers in that do better things than the older ones and get rid of the older ones. And so, the whole thing about business dynamism is basically adjust to new situations, new technologies, new demand, new costs. And if that is slowing down, this is really having a big drag on the whole economy.
Jan, I promised you to keep a close eye on the time because I know you have another meeting. And actually, I think we could have talked for a half an hour, or maybe an hour more. But just to sort of end this by piquing maybe people's curiosity, when I hear you, I sort of come to the realization that maybe some of the big debates that we're having now, we are focusing on maybe not the wrong things, but not on all the things. That is, for example, in the inequality debate, there's a really high sort of focus now on taxes. We should tax the rich more. But when I hear you talking, I'm also thinking, well, maybe we should just force interoperability on the big firms, and then competition will actually take care of this without the taxes. Of course, it's a nuanced world. Maybe it's a bit of both, right? But and second, I'm also thinking about Europe, right? The European establishment being very worried that we don't have these big firms. Again, I could imagine that if you force this interoperability, that you do see this innovation also coming from Europe. Finally, I think you made a really good case. You've presented the evidence. The markups are up, profits are up, stock markets are up. I think this is stuff that everybody can see. It's not so controversial, I hope, anymore. And the fact that this has very detrimental effects on the macroeconomy, I think, is also becoming increasingly clear. Inequality is such a huge problem right now. For me, my main takeaway is also maybe we should focus more on competitive markets, and that's not free markets. Or at least not in the sense that people often mean. It's better. Regulated is such a controversial word, right? But I thought your sports analogy was really good. Like better refereed markets, perhaps. Hope that sums it up, Jan. Is there any closing remark you want to make that I forgot? And otherwise, thank you so much for coming on.
No, I just want to, I'm glad you summed it up perfectly. I mean, basically, more competition is redistributive, and it's in the sense that you said exactly. It has to be better refereed. It doesn't have to be free market, free for all. It has to be better refereed markets, and this is going to have a lot of positive consequences. So I couldn't sum it up better than you have.
I'm happy to hear that. Okay, Jan, thank you so much for coming on, and I'm sure people will be very interested to have a look at your book now if they want to know more.
Okay, it was a great